good afternoon, or good morning, depending on what coast you are on. Welcome to the McQueen Financials ALM 101 webinar. My name is Heather Shepperly. I'm the Vice President and Director of Asset Liability Management here at McQueen Financial. And ALM is part of our three main services that we offer here, including investment advisory and valuations. I've been part of the ALM world for close to 2 decades now, not to age myself, and experienced the impact of rate cycles in our risk position along the way. And today we're going to talk a little bit about how the current rate cycle that we're in post-pandemic is impacting our balance sheet. And to do this with me today, I have joining us one of our fantastic seasoned advisors from our New York office, Matt Behar, who's been a great addition to our team. He's got many years of ALM experience as well, working with institutions of various sizes all over the country. So welcome, Matt.
Thank you.
Excited to have you join me today. I know we've been working together for years and see lots of crazy things that impact our balance sheet.
Yeah, this is definitely some unique times that we're seeing and interesting ALM report results that we're getting.
Yeah, definitely a few obstacles that we're going to be looking at today and how those things are kind of changing what our risk position may look like. So just a couple housekeeping items before we jump into today's webinar. We are going to, as we continue to walk through this, we do have an icon that is available through this view. That is our Q&A icon at the bottom of your screen. That is our question and answers. You are more than welcome to pop in your questions along the way. And at the end of the webinar, Matt and I are going to address those questions for you. So as those pop up, please add them to that list. And today's webinar is being recorded, and this will be available to you and your team through our McQueen Financial YouTube channel. So looking forward to today. And we're going to talk a little bit about a few things. So starting with kind of our overview of what we're going to discuss today, we're going to begin with the concept of what ALM is. Why do we do ALM? How are we to perform the analysis itself? We're going to talk about net interest income and NEV, or net economic value of equity. These two line items, these two bullet points are really kind of the kind of meat and potatoes of interest rate risk or asset liability management. These are the two main tests that we do. And Matt and I are really going to kind of dive into exactly what this means, how this impacts our balance sheet, and what are we going to use this information for. At the end, we're going to kind of summarize all the things that we're going to discuss and review today. And then at the end, we'll give you a little bit of a preview of our ALM 201. This is, again, part of our ALM series. We do 3 of these webinars through the year. First is our 101, then 201, and 301. Our first one, our 101 we're doing today is just the overview of the concept of what ALM is, the 201 getting into more assumptions, and then the third and our 301 in the fall, using that for decision making. So, and then again, at the end, we're going to do some Q&A. So please add your questions as we go through our presentation today. So starting off with what ALM is, Matt, can you kind of describe exactly what this means to us?
Sure. Thanks, Heather. Well, today we're discussing ALM, or Asset Liability Management. We'll be discussing ways to manage risks associated with your assets and liabilities that have different terms, different maturities, different rates, and at the same time, we're looking at ways to manage income.
And it's always interesting. This concept is not one that's the most intuitive. So you are going to see this here, which is ALM, or asset liability management, is the art and the managing of our mix and volume of interest rate sensitivity. I'm Italian. I tend to talk with my hands. I like visuals. So on here we have our little teeter-totter. And this is whenever we have people being new to the concept and coming in, kind of giving you a picture of kind of what that looks like. And when we refer to ALM, it's kind of that balance or that teeter-totter between both sides of the balance sheet. We know our liabilities, our non-maturity deposits, term deposits, and borrowings versus the asset side of our balance sheet, which is our loans, investments, and our overnight funds. So what is the balance between those two sides of the balance sheet as the market's going to change and move over time? How do we use this information to provide a constant positive net margin and making sure that we can handle what's being thrown at us in the market? And in order to do that and kind of have an idea, understanding the basic structure of how our balance sheet is working. So Matt, tell us a little bit about how the flow of funds kind of works for us and how that can kind of tip that teeter-totter.
Right. Yeah. I mean, as we're seeing here, the money that comes into an institution typically doesn't match the amount that is needed to go out. I mean, especially in today's high rate environment with our continued focus on liquidity, institutions are continually have to manage potentially a greater demand for an outflow of funds than they have. So you may have to institute strategies such as increasing loan rates if the loan demand gets too great, or borrowing if that's appropriate for your institution.
Yeah, definitely had some obstacles recently with some liquidity concerns. So, ALM is, we joke a lot, that's a little bit of science and a little bit of art. We want to channel our inner Bob Ross and kind of understand how some of this is going to impact. Matt, when looking at this, each institution is unique. What do we kind of mean by that? And how is the science part really going to impact us?
Right. Yeah. Every bank, credit union, each institution has different clients, different competitors, different makeup of the balance sheet in terms of different assets and liabilities. And I mean, the goal is to just find the mix that works for your institution.
Yeah. And that's the main thing that we want to do and, kind of why we do ALM modeling. We know we have to do this for regulatory purposes. This is a requirement. This is what we're going to do. We're going to take this and we're going to check off that box, and we're going to throw it in a drawer until the exam comes in, right? Not usually, because of the structure of the balance sheets being so different. We want to use these tools to be able to kind of look ahead. Everything in our world is that science part, which is looking at more the accounting side, looking at historically what has our balances been, what are our yields, what is the structure of our balance sheet. This is looking at our earnings and our current balance sheet position. What has that been for us? And the ALM is that looking forward, which is more that art part of what is our projections in the future, what's going to happen over time to our balance sheet as the market may be shifting. And because, like Matt mentioned, every institution is so different and that structure looks different. So when that occurs, we need to know how is our balance sheet going to be able to handle the movements that may be happening in the market. And ultimately, what we want to do is we want to catch problems before they're actually going to occur. So this next page really gives us, I love this picture and this crystal ball reference because we don't know what that looks like. And we're trying to play a little bit almost like a guessing game. But what does that really crystal ball kind of show us when we're looking at an ALM report?
Yeah, I mean, like you mentioned, we're trying to anticipate the impact on your risk and your income if market rates change, if market rates go up or down. And also in ALM, we're looking at a static or no growth balance sheet. So it is important to look forward and run some type of dynamic or what if scenarios. At McQueen, we do have our own tool, or MFA, or McQueen Financial Advisors Navigator, where we can load in, say, your budget, or show the impact of adding a new loan type to your balance sheet, or purchasing a new type of investment, or running a CD rate special. So it's important to look forward and see what impact this has not only on income but also on risk. We'll dive into that a little bit more when we talk about a little bit more about dynamic planning and scenarios in our further slides.
Yeah, it really kind of gives us a nice picture of a lot of those things. So we normally run these on a quarterly basis, correct?
Yes, that is the best way to do it because balance sheets are changing, things in the market are changing, and like you said, we're trying to prepare for challenges and issues before they occur. So running on a less frequent basis, you may miss those changes and take on more risk or have more impact to income without being able to anticipate it.
Yeah. It's amazing how fast things have been changing. We saw so much of that even in the last couple of years of how fast that impact can really be to our balance sheet. So as we kind of dive into this next section, we're kind of understanding, what ALM is. We know why we have to do it and why we should do it, but how do we do this and what is this telling us? So as we start to look at interest rate risk modeling, we want to our ALM takes a snapshot of our current balance sheet and attempts to access the impact of both interest rates in the different environments, and then also what that impact is going to be to our institution. So a couple things here we have to do when we look at interest rate risk modeling. Examiners want to see a starting point static balance sheet. So that snapshot of what that balance sheet looks like today. The nice part or bad part about ALM is the fact that you can use that art part to make your balance sheet look any way you want to. And what that means is we can put in growth assumptions or changes to the balance sheet to improve our position or to be more conservative and make it a little bit more risky. This is something that we want to look at and understand what that impact looks like. And from an examiner standpoint, we have to have what's called a baseline. And that baseline is assuming everything stays flat for the next 12 months. There's no changes to the balance sheet. That keeps us from hiding our risk position based off of that art part that we may be able to implement in. That doesn't mean that's not an exercise we should do, but it just means that we need to start with this static no growth environment as that baseline look at what our risk looks like. So you're going to see some of this as we go through the pages of that 12-month forward projection, assuming all balances are going to stay flat for that time period. And then the nice part is we then are going to use that as our baseline, and then we're going to layer on top of it more real world situations. What's actually happening to our balance sheet? How are things changing? Do we have a plan based off of what we had put together in our budget for the previous year? Let's go and run those scenarios and see what that impact could look like, and to see that before and after of here's our baseline, and then here's more of a real world shift or change that may occur, really helps us be able to make those decisions going forward. And we're going to get more into exactly how those impacts could look to our balance sheet. So this first page is looking at that 12-month projection. So the concept of what we're doing in ALM right now is that over the next 12 months, all the balances are going to stay flat. And you can see this right here of looking at the cash flow that we're just an example of the movement that happens over that next 12 months. Our cash flow is showing that we're going to have $1,868,000 coming due in the first 3 months, and then continuing over that 12-month time period. And say the current rate of that, say, loan pool is sitting at 685. The assumption in the model is assuming that that cash flow is going to stay flat. You're going to see that same thing happen in our rollover. The only difference is we know we're going to put those same dollars back on the balance sheet, but we're going to do it in the current market. We know the current rates in the market are different than the loans that we have put on over the past few years. And let's see what the ending point of that income would look like based off of those changes over that 12-month time period with the current market rates. And this example shows this going from a 685 average pool rate and the new loans going on the books at a 925. So at the end of that time period, it looks like, Matt, this is going from a 685 to a 705. That seems like that might be a little bit higher. We're seeing some of this move on this page as well. As we start to shift and we see maybe an example of the entire loan portfolio going from a 711 to 763. We're seeing kind of that same change that happens over on our investment portfolio too. This seems kind of like a big jump. Is this something that we're seeing standardly across the board, or is this kind of a unique situation?
No, it definitely seems reasonable in our current higher rate environment. What we're seeing here is those loans and investments are just repricing to rates that are higher than you currently have on the books. Like you said, that last column, that December 2024 represents a 1 year forecast from the time we're running these reports. In this sample, it's as of December 31st, 2023. So we're looking at January through December 2024. For the loans, those principal payments that are coming back to you, we're assuming they're going right back on the books at the higher rates and the same type of loan. And the investments, we're assuming you're getting that investment back, putting it right back on the books at the same type of investment, which currently would be at a higher rate, is what these results are indicating.
definitely starting to get some of the benefit on that rising rate environment. We had a lot of these loans on our books that were locked in at these hyper low interest rates in the beginning of the pandemic. As we're seeing that changeover happen over time. And actually, this is the nice part with some of these trends that you see in the models where you can go back and look historically where we are versus where we're going. And you can see this nice change and jump over those couple year time periods as we're kind of encompassing what we can capture in the actual market today. So again, why it's so valuable to be able to see that snapshot over time of what's happening and how those changes are happening. So Matt, a little bit earlier, I mentioned some rate cycles and the impacts of the balance sheet. I know things have slowed down a little bit, but definitely still a focus point. We've got some interesting trends, especially when we look at deposits and then the position of what we've had to do on the balance sheet to offset some of those flows of funds that we were looking at in an earlier slide. What are the patterns that we're seeing here and why is this happening?
Yeah, no, absolutely. This is nothing out of the ordinary. This is very typical from what we're seeing. Most of our reports that we run for our clients, those non-maturity balances have decreased over the last year, just with things being more expensive and rates being higher, possibly at other institutions running CD rate specials. The depositors are pulling money out and for those purposes. So we're seeing these big decreases over the course of a year. We're seeing that CD balance, in contrast, increasing with the higher rates. If you look at the rates associated with those, either rates were increased across the board or there was some kind of CD rate special run. And then also in this example, we do have the borrowings increasing. So a couple of points here. Again, why it's important to run these reports on a quarterly basis. We see how much these balances are fluctuating in this case. And also, we were talking about the mismatch of money coming in, the cash flows coming in and leaving an institution. Here we see how potentially this institution needed to make a decision, one, to raise those CD rates to get back some of the funds that have left, as well as looks like borrowing made sense in this situation.
Yeah. I mean, definitely that balance with liquidity happening. We want to control that rising expense as best we can. And sometimes it's locking it in those term deposits versus seeing maybe some very fast increases in those overnights. So making sure we're getting a nice balance there. Again, looking at the interest rate risk that goes hand in hand with this and what is best for our balance sheet. So when we look at our interest rate shocks, so we talked about our standard balance sheet, we're assuming this static environment for 12 months. And then our second layer to this is getting into this net interest income piece, which is going to do a shock test. And that's going to be the first of the ones that we look at. So when we start off, our standard model is using a parallel simultaneous rate shock of 100 basis points. And that is one of the steps that we're doing. You can see in a rising rate environment, we'll go 100 basis points, 200, 300, 400, and then the down in the same manner as rates are high enough where we can see rates drop 400 basis points. So when we do a shock test, what that means is as we look at that 12-month time period, if rates are going to increase, it's going to happen on day one. We saw this actually as a downturn when the pandemic happened, where the Fed came in and overnight they dropped rates to bring it down to 25 basis points, being aware of what we were going into. So when things happen instantaneously, that is a shock test. And the assumption is if rates change, they're going to change on day one and they're going to hold steady for that next 12 months versus a gradual test that we'd like to be able to look at as well, which is a slow, steady change over time. So if rates go up 300 basis points, if it's a shock, it's going to raise 300 basis points on day one. If it's gradual, it's essentially 25 basis points a month over the next 12 months. That slow, steady change over time. So in most environments, the gradual test is a great management tool to kind of monitor and watch those changes that are happening and what that impact will look like to our balance sheet as that slowly changes versus the shock test, which is more of an examiner test of that worst case scenario, instantaneous, what is going to happen to our balance sheet if things change basically overnight. So this first test is again net interest income. This is the impact of both the asset side of the balance sheet and the earnings and the liability side with our expenses. And just to see what that net is looking like for us. And then we're going to test this as rates start to move. And as we go on to our next slide, this really kind of gives us a good view of the structure of what that looks like. So the first is our income. So we're looking at net interest income. So all we're capturing is any interest sensitive item. So anything that's tied to an interest rate. So this is looking at our loans and our investments, our overnight funds, and then the expense side of our non-maturity deposits, term deposits, and borrowings. So what this test does is it goes and looks at our net interest income of our loans and securities. Our current is our base case, assuming again, static balance sheet, no balances have changed over that time period, and no rates have changed over that time period either. It's still the same rate environment we're experiencing today. Now, as rates go upward, this is assuming, again, a shock test. If rates go up 100 basis points, that happens on day one, and then it holds steady for that time period. And what would that impact look like? And it does each of those rate shocks in an up scenario. And then the same as rates drop downward. What does that impact look like for us? And that's what our net interest income is going to look like. Now, what we're seeing here are dollar changes. As you see those dollar changes, that might look great, but that may not give us the full picture of what that necessarily means for us. Is this good? Is this bad? Do we have flexibility on what we can do? So kind of we want to layer in some additional looks at this to kind of give us a little bit more an idea of, is this an appropriate level of change for our balance sheet? So Matt, when you go to do presentations in that, I know this is kind of some of the views that you may be looking at. What does this tell us and how can we use this information?
Yeah, I mean, just like you showed on the other page, what we're looking at here is what happens to your net interest income if market rates go up or down, and the different scenarios we're using are 100 basis points, or if rates go up 1%, 2, 3, 4%, or if they actually fall 1, 2, 3, 4%. How does our base case or no rate change forecast change? Or how does the income in each of the rate shock scenarios change in relationship to that base case? And that's what those percentage changes are in our green bracket there. And we're comparing them to your policy limits to determine whether or not that change from the base case is acceptable to your institution, or if you're comfortable with it in general. In this case, we see all the percentage changes are lower than the policy limit. So we have these green check marks to indicate you're within your policy limits. They're low risk changes and they would be acceptable to your institution.
It's a nice view to be able to see that, how relevant is this to us and are we in a good position based off of, how we feel. So we can do some additional exercises with this information to help with decision making, correct?
Yeah, I mean, a good point, a good starting point to understand your risk is looking at these types of questions and seeing if there is something on your asset side or liability side that's causing the biggest change in your net interest income in those different rate shock scenarios. Are you comfortable with the change? Are the changes overall within your policy limits, or do you need to make any changes on the balance sheet to smooth out or bring that any NII sensitivity back into levels that are within your policy and your comfort levels?
Yeah, I think it's going to be a great exercise, especially if and when rate starts to drop, how much can we handle? And are we structured in a way where are we going to be able to handle that impact as that income's really going to change over time? I know there's some interesting things going on. We're going to dive a little bit further into that in coming slides, but definitely some great information to be able to understand, what does our balance sheet look like in these environments. So this first test that we talked about was that net interest income and that change in our cash flows. Now, as we look at the second test, this is our net economic value of equity, or NEV, or you're going to see this referred to as NEV. Basically, what this is this is our market value of our balance sheet. What is the market value of our assets versus the market value of our liabilities? And what we want to do is we want to understand the value in the market in comparison to where we are today. So when we looked at net interest income, that was that 12-month forward projection. What's going to happen to interest rates over time? What's going to happen to our interest income over time, that net interest income as things change? Well, that's a 1 year forward projection. Neve is actually a snapshot as of the time period of when you're running that report model. So as we look at, as we're going into March 31st, and you want to see that snapshot, what it's going to do, it's going to value all of those interest sensitive products as that moment in time against the equivalent of the market. And how much value does that hold? So, an example of this is valuing this like a bond. We're looking at the value or that principal cash flow. How valuable is that cash flow to us in comparison to a coupon rate in the market? So, one drawback we have of all the activity that happened during, say, 2021, we saw market or really record low rates on especially mortgage loans, and you saw a ton of refinancing. We probably have a lot of mortgage loans on our balance sheet that are sitting there for a long period of time. If we look in a rising rate environment, those don't hold as much value for us because we're locked in around 3% versus the market equivalent that's offering us 7%. So as we look at that, our value is going to reduce as rates start to go up. But in the same view, looking if rates go down, that's going to boost and hold some value to us as the market may be, offering lower and lower rates, and we may be able to hold on to some of those. So just valuing each of those moving pieces on what is the value of the equivalent in the market. So, Matt, I know one of the first things that we have to do, especially when we're looking at, say, assets and investments and loans, we're valuing this back against the treasury curve. This doesn't look like what we would want it to look like in regards to value and risk that goes hand in hand with duration. What is this kind of doing to our balance sheet right now based off of what the position of where the market is?
Yeah, what we like to see is that black dotted curve on the bottom where it's kind of an upward sloping curve, meaning as you invest for a longer period of time or put longer term assets on the books, you would get rewarded with a higher rate of return. But we're not seeing that today, and we haven't seen that for a little while at this point. We're seeing this, we call it flat and inverted curve, where the shorter term rates are actually higher than the longer term rates. So if you're buying a 1 year CD, your rate is higher than a 3 or 5 year CD, which seems counterintuitive. We typically don't see that. And even to add to that, once you get past, say, that 1-2 year point, we see this flatness on the curve where you're not even getting rewarded much at all for going a lot more longer term. In terms of our ALM modeling, when we're when we're doing your net economic value and you're trying to value everything against these current market rates, we're definitely getting some interesting results, especially when we're looking at those shorter term assets that you have on the books, because those are getting compared to those higher current market rates.
Yeah, it's definitely bending that Neve position in different ways that we would normally see. So again, the importance of having this ongoing look at where we are in comparison to the market. You could sit on your hands and do no changes and allow your balance sheet to just stay right where it's at, and your Neve position could change simply based off of what the market's giving us. So these unique environments are really kind of the purpose of the test, is what's happening to us as these things are changing, and can we handle those movements and these positions of the curve that we may not normally like to see or want to see, but understanding what that looks like for us. So, Neve is not the most intuitive concept to wrap your brain around, especially when you're looking at both sides of the balance sheet and what this, means for us. So a good visual of the general concept. Again, we just looked at this yield curve. This is not a normal position. Things are varying slightly, especially with this very flat rate environment. You're not necessarily seeing as much boost in value or really as much of a hit to value either. But with the concept of what this is and how our value changes, duration has a very large impact to how that teeter-totter is going to tip. So the longer your assets are, or the longer your liabilities are, the more change or impact to a premium or a discount to the value of those items is going to change. So a good view and comparison to kind of get the picture of how this is tipping is looking at a 30-year mortgage. This is probably one of the longest assets that we'll have on our balance sheet, and that will hold the most amount of risk based off of how the market is shifting and changing. And you can see this green line where these are really going to tip. Again, referring back to those mortgages we put on the books, back in 21, we've had some turnover of those loans, new loans going on the books. The value of those are starting to come up. We're seeing our overall pool rate slowly increase on those mortgages. But if rates continue to rise, we're not going to get the value because that incentive to refinance those mortgages at higher rates, most are not going to choose to do that. So as rates get higher, the value of those mortgages are going to devalue because the equivalent of the market is higher than what we have on the books. Now, the offset of that is as rates go down, you're going to get more of a boost in value because the market may be at lower and lower and lower rates, but we have a little bit higher rates on our balance sheet. So that's kind of the concept of longer duration is going to give you a little bit more sensitivity in an up scenario from an asset standpoint. And then as that longer duration's happening in a down scenario, it's actually going to give us a little bit of a boost. And you can see a kind of a midterm equivalent of 48 months. Autos are going to have some sensitivity, not nearly as much as those 30 years, but it's still going to kind of tip in that same manner versus overnight funds, which is immediately, it's going to reset right away with the market. And you're going to see that value is basically not going to change because whatever the market equivalent is, that's what you're going to earn on those assets. So that's kind of the concept what you're seeing from the asset side of the balance sheet. Now, on Neve, when we get to liabilities, this is that counterintuitive end. So when we look at the duration of our liabilities, Neve is net economic value of equity. So we're going to look at what is the value of all of our assets minus the value of our liabilities. And the remainder of that is our net economic value. So the less we take away from our assets, the higher that value position is going to be. So if we see these items devalue at a faster pace, that's actually more of a premium to us. Again, the liability side is that counterintuitive, is that opposite direction of our assets. So if these values are going down, that actually means we have more of a premium to these products versus if they go up, that's actually a discount to those. So, or devaluation to those. So that's kind of the concept with our overall Neve position. And then as we come into kind of the summation of those two things together, this gives us our overall percent change of that. We have our dollar change that happens to that value, but then we also have that percent change that's happening here. Now, there's some interesting things happening. Again, going back to our current market and this current rate cycle has a different impact to our balance sheet right now, as we talked about the position of our current yield curve from the Treasury and just the structure of what our balance sheet looks like. Normally, you would see more of those straight linear teeter-totter lines. Right now, we're seeing more of a non-linear movement, as you can see here. We're going to talk a little bit more about this in a coming slide, but this really gives us our overall view of that the value of assets minus the value of liabilities and what that sensitivity looks like in that up and down. So Matt, similar to net interest income, do we kind of do the same kind of look with policy when it comes to the value side?
Yeah, absolutely. The difference, like you mentioned, with net interest income being a 12-month forecast from the time we're running the reports versus net economic Neve or net economic value of equity, it's a point in time measurement. So in this example, as of December 31st, 2023, we're assuming these market rate changes happen, rates go up 1, 2, 3, 4% or down immediately, and we revalue everything on the balance sheet as of December 31st. Compare that to that base case again. And yes, we look at the policy limits, see if those percentage changes are acceptable in terms of those limits. And in our example, once again, we see everything is lower than the policy limit, and that indicates it's a green check mark. Nothing is out of policy in terms of the changes from the base case in these different rate shock scenarios.
This really gives us a nice view on, what's reasonable for our balance sheet. And again, like we talked earlier, the market can really throw things at us that's going to move and tip this needle in a way we can't necessarily control. So when we look at this against policy, it really gives us a nice view of kind of where we stand, how things are happening, and then continuing to keep an eye on those changes over time. So, Matt, we still want to continuously do some additional exercises and pieces for all of this. What are the things that we really should be doing from a Neve standpoint?
Yeah, similar type of analysis of the results as we did with net interest income. We identifying is there something on the balance sheet, like you said, for example, 30-year mortgages or some other asset or liability causing big percentage changes in those different rate shock scenarios. And yeah, can you explain it? Can you identify why those changes are occurring? Excuse me. And do you need to make any changes to your balance sheet if say you were outside of policy and you needed to make an adjustment to the amount of those mortgages or add a certain type of assets to smooth out that sensitivity, and overall, are you comfortable with the results?
And that's really the biggest piece that I think a lot of examiners expect and hope to see. And auditors may come in just making sure not only do we see what's happening, but do we understand? And are there things that we need to do to maybe mitigate some of that risk or position? Or are we set up in a manner where we're ready to handle that next step? So one of the items that I had mentioned earlier is in regards to some nonlinear changes. Again, we were looking at the treasury curve. We see kind of the unique position we're in. We're talking earlier about deposits. Liquidity was a big concern for us for a while. And as that was occurring, what we generally see is if we have to kind of bring deposits in the best that we can, we're going to do this in a manner of where we can control our expense. So when we do this, we're really going to focus more on term deposits or maybe borrowings. This is some of the items that Matt was referring to earlier, where the structure of the balance sheet sample that we were looking at was those non-maturity deposits can continue to leave the institution. So we need to do what we can to bring those deposits back in. And as we did that, we would focus more on term deposits or borrowings because we could control that expense more. Now, when that occurs, that means that we're not going to move our non-maturity deposit rates nearly as fast as we would other types of liabilities just to control that cost because these are liquid. If we raise these rates, we're going to raise the rate across the board for that entire product, and that expense is going to go up on day one. Again, a shock environment. Right away, that expense is going to go up. So as that occurs in a liquidity squeeze, we're focusing on other types of products. So what that means for us when we look at our non-maturity deposit pricing, most of these prices were very, very low, and we didn't necessarily raise them very high, which was fine and great when we were holding on to our trying to control our expense in that type of environment. Now, the drawback of this is because rates have increased over 500 basis points since the start of the pandemic, we can really continue to drop rates for a long period of time. We didn't have to do that. We didn't have to raise rates for a while because we had too many deposits. And then as those deposits started to run out, we started to price higher in other areas. So as that occurs, what tends to happen and what we're really seeing a lot is the fact that our cost is going to floor out almost instantaneously, keeping us from being able to reduce our expense as rates go down. And we're going to see a reduction on that asset side of the balance sheet, whereas that cash flow rotates over. And again, in a down scenario, if rates are going to drop, we're going to see that interest income go down because as loans go back on the books, they're going to go back on at lower rates. Our investments are also going to do the same. Right now, the projections, our rates are increasing, so we're going to see that go upward. But if things start to go down, we want to be able to reduce that expense or that liability side almost as fast as we're seeing that reduction on assets, if not faster, so that we can still have a nice margin. But right now, we're in a position where there's not a lot of room to move. So what we see is as checking costs are on average, say 5 basis points, if rates drop, we can go down about 4. We can only go down to 1 basis point. That's the lowest we can pay on these. Otherwise, they become non-interest bearing deposits. So if our cost is going to floor out right away, you're going to start to see that squeeze. Those asset rates are going to drop, 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 and we're not going to be able to reduce our expense at the same time. So this is something that we need to be prepared and understand that when we start to look at some of our sensitivity, these down scenarios are kind of waving. It's very dependent upon how fast can we change rates in our liabilities and what is that going to look like for us. So this is one piece that we need to monitor and watch for the year 2024 is that cost impact is that squeeze of that margin because our liabilities are flooring so quickly. Now, hopefully we have some term deposits and some borrowings that we can see some reduction of expense, but that's really a piece that we're seeing across the board for a lot of balance sheets right now. So something to definitely be prepared for. If you see some of those kind of nonlinear shifts, you're not seeing that perfect teeter-totter balance back and forth. You're kind of seeing that kind of have a little bit of that upside down V look. So
Yeah,
Matt, have you seen some clients kind of having this impact right now?
yeah. I mean, definitely the impact of those lower cost shares like shares and or deposits as you're showing there are hitting those floors, and you might ask why are we running these down scenarios if this is happening, if we're reaching those floors right away. Well, like Heather said, on the asset side, the loans and investments can fall by 4%. There is a time if rates come back down again where we may remove that down 400 scenario because loans and investments simply cannot drop that far, and we might add an up 5 scenario. So it's good to be able to have that flexibility in your reporting as well.
Gives that good view of all of those rate environments. So exams. Matt, I know this is a major focus point right now. There's a lot that goes kind of hand in hand with that. What are the things that we need to focus on that we know examiners are going to walk in the door and where their focus point is going to be in regards to interest rate risk or asset liability management?
Sure, this is everybody's favorite topic. Preparing for exams with the ALM reports. Yes, that's definitely one of the purposes of running the reports. Your examiner, either FDIC or NCUA, are concerned with insuring your deposits. So they want to see the viability and the financial soundness of your institution, and looking at the net economic value of equity, the NEV and the net interest income or NII, and seeing those different rate changes and identifying those percentage changes in the different rate shocks environments. Just like we said, you are trying to identify any issues or challenges or problems before they occur. The examiner is doing the same exact thing.
So we've had a nice little sneak peek on some of the focus points for 2024. Definitely seems to be a lot of focus in this area specifically.
Yeah, this just emphasizes the importance of ALM, and for this year, NCUA specifically came out with this list of supervisory priorities, things they're going to focus on, and right there on the list, interest rate risk management, which ALM is part of.
Mhm. Yep, definitely a lot of focus here as that continues to happen. And they are concerned about a lot of the things that we've already talked about today, about how the market is just throwing some very unique situations at us, causing that risk position to look a little different than we would normally expect to see. So obviously that is, we're kind of under a magnifying glass right now, making sure we understand all of this. So as we use this tool and we use this information, and say we are in a position where we may be pushing policy or outside of policy, and this isn't right for our balance sheet, we can use this tool to do something. So trade-off, what exactly do we mean by that, Matt?
It's just what we said at the beginning. We're managing the differences in the maturities and the rates and the terms for the assets and liabilities, and while also focusing on income. So as we've shown several times, adding a longer term asset like a 30-year mortgage at a higher rate is great. I mean, your income will be up. However, that longer term fixed rate asset will drop in value if market rates go up. So your net economic value of equity, the NEV, will decrease although income is increasing. Not necessarily a bad thing. As we've been identifying, it's just a balance of, can you take on that risk while growing your income in that manner?
Yeah. And I think that's where really policy, again, helps kind of give us a framework of what we can handle. So if we are going to do those trade-offs and we want to make more profitability but take on more risk, how do we know that that range is going to be appropriate to us? What kind of guidelines we're using to determine that that's the right trade-off for our balance sheet?
Right. Yeah, your policy should align with your goals and your balance sheet. I mean, can you take on those certain types of assets and liability mix and the amount of risk associated with those? So one thing you wouldn't want to do is establish a policy where you're out of policy right away. So you would look at these ALM report results, see where you fall in terms of your NEV and NII, and see if any adjustments are necessary. And then looking at your policy limits, does it make sense? Do your policy limits still make sense in terms of where you are, or do they need to be adjusted?
Yeah, it really gives us a good framework of what's right for us. I know one of the things that Matt had mentioned earlier is doing some simulations and really kind of looking at what that position could be and what that's going to look like for the future. So kind of summarizing some of the things that we've talked about, don't think of ALM as a regulatory burden. This is this is a requirement. This is something we have to do for our balance sheet, but this gives us such great information to make proper decisions. We want to see the impact of new products. We want to assess where is our risk position at right now. We want to stay ahead of those problems and we can be proactive versus reactive. So, some of the things that we've implemented to kind of help with a lot of those decisions are things that are really going to kind of open up those conversations. So we know we have to run, again, ALM being this static balance sheet environment, assuming everything stays flat for the next 12 months. We also have to assume this parallel yield curve. So that treasury, assuming that if rates are going to move 100 basis points or 200 basis points, short-term, mid-term, long-term rates all move that same pace. They either go up 100 basis points, 2 or 3, or down. Everything's going to move in lockstep. So assuming the static balance sheet in this parallel rate environment, what we want to make sure is, okay, this is our baseline to look at what is our starting point. Utilizing the tools that you have at your fingertips to be able to make different decisions. One of the things that we really enhance here at McQueen is our web application, that MFA Navigator. We want to be able to use all of these tools to kind of help with some of those decisions. So we know we have the static balance sheet as our starting point or our baseline. From there, we want to look and say, all right, maybe we're not having as much issues with liquidity anymore. That's starting to stabilize a little bit. Now we can really start to get a little bit more aggressive when it comes to the asset side of the balance sheet, investing those funds. Should we look at different loan programs as we're coming into spring? People are not moving. They're holding on to those low interest rate mortgages. Are they taking the equity in their house and putting that money back in? Do we have opportunities as the weather's starting to break? Are we going to see some equity opportunities there? As we put that money to work in our loans, is that the right thing for us to do? If it's a fixed home equity product and it has some more duration, do we not have as much room to take on more risk there? Do we need to maybe put it in the investment portfolio instead? Have something a little bit shorter in that turnover? These are the things that we can use that navigator to put in these dynamic situations and be able to move dollars around, change rates, really see that before and after impact. What does net interest income look like? What does NEV look like? Are these the right things for our balance sheet to do? Examiners want to see you doing these activities. They want to see that not only do I understand the baseline of where we stand, but how am I using this tool to help make the right decisions on trying to mitigate that margin squeeze that we're expecting to see? Are we trying to move those dollars over as fast as we can and grab onto those higher interest rate products? Just being concerned with that movement or that change in time. So utilizing those tools, really holding on to those, help make those decisions. Again, stay ahead of potential problems, be proactive, not reactive. It's a very powerful tool that you have and different ways that you can look at it despite the regulatory guidance stating that we have to just do this, this, and this. You can play around with those and do these different movements in the balance sheet, really have an idea of what we can do.
Yeah, and those different scenarios provide the support for making those changes to your balance sheet. I mean,
Yeah.
you'll proactively be aware of the changes to your NEV and your net interest income.
Yeah. It is. It's such a great tool to have and to really help with that. So, hopefully you got a nice kind of general concept of what asset liability management is, or interest rate risk, kind of understanding that piece. The second layer to this, as we would look kind of forward of a preview of what our ALM 201 is getting into the assumption side. Now, a little preview to that as well is we're seeing a lot of examinations very, very focused on the changes that have happened over time. Are our replacement rates appropriate? Have we upped our rates and our loans correctly? Have we been a lag in the market? What does that look like? Are we pricing where we need to be? Are we moving our rates as fast as we should? This is those betas in the up and down. How fast do we respond to the market, and how fast do we change those rates? And then prepay speeds. Prepay speeds are going to be very volatile and change very quickly based off of what the market's offering. So as rates go up very fast, those prepay speeds slowed way down. We actually saw a lot of this, especially on the mortgage sides, where they basically floored out, similar to the rates on our non-maturity deposits. We saw those prepay speeds basically come down to about 6%. Where as rates start to reduce, we're going to see those speeds start to pick back up again. So prepay speeds are a big impact for us. The duration of those non-maturity deposits. We know this is a large focus point when liquidity was a concern of how sticky are these non-maturities? Do we have the right duration in there? Because the longer those deposits stay with us, the more value that holds. So there's a lot of assumptions that go into the model that kind of drives what that interest rate risk can be. So just know, again, as a preview, that examiners are very focused in these areas, making sure that this art part of ALM, as I refer to this Bob Ross part, are these numbers appropriate for us? Is this how we're responding to the market? Is this how our depositors are responding? What does this look like for us? Is this the right assumptions we're using to capture what we're actually experiencing? And that can vary so vastly from one institution to another. So again, making sure we're using the right pieces there. And that's what we're going to get into our next webinar next quarter, is really that assumption side, or that art part of ALM.
Yeah, there's so many assumptions. We devoted an entire webinar just to the assumptions. I'm sure we could do 4 hours, an hour on each one of those bullet points if you wanted to, because they, like Heather said, those assumptions vary from institution to institution.
Yeah. It's amazing how much updates and changes and relooks at things we've done. Again, kind of that look at the historical trend that's happened over time. How have we responded? Use that information. We show a lot of trend analysis through our models, how things have changed over time. Use that information to help look at these items, make sure those assumptions, make sure that our model is locked tight. It's doing the things that how we actually are responding. So definitely some great information we'll get into in that next webinar. So, Matt, any final thoughts on today in regards to asset liability management?
Yeah, I hope we gave you a good introduction to ALM 101, and gives you some tools to at least have a basic understanding of how things are changing on your balance sheet in terms of risk and income when you're looking at these reports. And I would just say make sure you're using the reports and not just filing them away or just doing them for regulatory purposes. There's a lot of value in these reports. I hope we conveyed that today.
Yeah. Yeah, and definitely great tools to use. One question that did come in as we were going to open up our Q&A section, one question that did come in is policies. If this is something that we're not as comfortable with or know how to approach, is this something an advisor can kind of help us with to develop a proper range in testing?
Yeah, absolutely. That's I had mentioned earlier. First, you would want to run your ALM reports, and then you can develop a policy if you don't have one, or update your policy. And yeah, and that's definitely something we do here at McQueen. Included with our ALM service, we would provide you not only with a review of the ALM results, so you understand it, you're comfortable with the results, but we can also help you develop a policy and actually provide you with a suggested policy to bring to your board or ALCO.
Wonderful. Well, thank you, Matt. And
Thank
we
you.
want to thank everybody for joining us today. If you have any other questions, please feel free to reach out. So we have both my contact information on here and Matt's as well. Please also reach out to your MFA advisor if you have any questions. Today's webinar has been recorded, and this will be available through our YouTube channel. You'll be able to see the entire webinar today available to you. And once that is up on the YouTube channel itself, those links will be shared so that you can go to that. And then our next webinar that's coming up is going to be our Investments 101. That is going to be on April 4th of this year, and then it's going to begin at 2 p.m. So again, thank you so much for joining us today. Thank you, Matt, for joining me. It's always
Well,
great
thank
doing
you.
this. And thank you again.